studying your last two. I swim med tid when they turned in. The staring out to mute. And can learn the pole that sunk he died.
One of the most important concepts in owner-manager tax planning is understanding the difference between declaring a bonus and paying a bonus. Many business owners assume that once a bonus is declared, the corporation automatically receives a tax deduction. However, tax preparers must understand that these are actually two separate steps, and both must be completed properly. The first step is declaring the bonus. This typically happens when management or the directors decide that additional compensation should be paid to the owner-manager or employee. A formal bonus resolution is prepared, documenting the corporation's intention to pay the bonus. From an accounting perspective, an entry is recorded, salary expense is increased, and a liability called bonus payable is created. At this stage, the corporation has recognized an obligation to pay the bonus, but no money has actually changed hands. This is where many people make a mistake. A declared bonus by itself is not enough. Simply creating a journal entry or signing a resolution does not complete the process. The bonus still needs to be paid. That brings us to the second step, bonus payment. The bonus must be processed through payroll just like any other compensation payment. Appropriate payroll deductions must be calculated, including income tax and any applicable CPP or employment insurance amounts. The employee or owner-manager must actually receive the payment, whether by direct deposit, check, or another approved payment method. Once the payment is processed, the related source deductions must also be remitted to the Canada Revenue Agency according to the required deadlines. Notice the contrast shown on this slide. On the left side, we see the risk scenario. A bonus has been declared, but no payment has been made. The bonus was not processed through payroll, and this can create significant tax problems and CRA adjustments. On the right side, we see the proper process. The bonus has been declared, paid correctly, processed through payroll, and all compliance requirements have been satisfied. This is the outcome every tax preparer should be aiming for. The key lesson from this slide is simple but extremely important. A bonus deduction requires both declaration and proper payment. Declaration creates the obligation. Payment completes the transaction. As tax professionals, our responsibility is to ensure that both steps occur correctly, are documented properly, and are completed within the required timelines. Understanding this distinction is the foundation of successful year-end bonus planning and one of the most important concepts you will encounter when working with corporate owner-managers. If there is one deadline every tax preparer working with owner-managed corporations must remember, it is the 180-day bonus rule. This rule is one of the most important deadlines in year-end tax planning because it determines whether a corporation will actually receive the tax deduction it expected when the bonus was declared. Let's walk through the timeline. Everything begins at the corporation's year-end. Imagine a company with a December 31st fiscal year-end. At that point, management may decide to declare a bonus in order to reduce corporate taxable income and compensate the owner-manager or employee. However, declaring the bonus is only the first step. Once the bonus has been declared, the clock starts ticking. The corporation now has a maximum of 180 days after its year-end to actually pay that bonus. As you can see on the timeline, the countdown moves through 30 days, 60 days, 90 days, 120 days, 150 days, and finally reaches the 180-day deadline. Before the deadline arrives, the bonus must be paid through payroll, and the employee or owner-manager must actually receive the payment. If the bonus is paid within the 180-day period, The outcome is generally positive. The corporation is allowed to claim the bonus deduction. The compensation planning strategy works as intended. Taxable corporate income is reduced, and the year-end planning objective is achieved. This is the green zone shown on the slide. The bonus was declared, paid on time, and properly executed. Now let's look at the red zone. If the bonus is not paid within the required 180-day period, significant problems can arise. The bonus deduction may no longer be available as expected. The expense can effectively be added back for tax purposes. Corporate taxable income increases. Additional corporate tax may become payable, and the entire tax planning strategy can fail. What initially looked like a successful year-end tax plan can quickly become an expensive mistake. This is why experienced practitioners treat the 180-day deadline as a hard compliance deadline, not merely a target date. In fact, one of the best professional habits is to avoid working right up to the deadline. Notice the practitioner tip at the bottom of the slide. Never wait until day 180. Build a safety margin into every bonus plan. Unexpected events happen. Clients become busy. Documents get delayed. Payroll processing takes time. Banking issues occur. Staff members go on vacation. By scheduling bonus payments well before the final deadline, you significantly reduce the risk of a missed deduction and eliminate unnecessary stress. The key takeaway from this slide is simple. A declared bonus only creates an opportunity for a deduction. A bonus paid within 180 days turns that opportunity into a successful tax result. Understanding and monitoring this deadline is one of the most valuable services a tax preparer can provide to owner-managed corporate clients. At this stage, we understand the difference between declaring a bonus and paying a bonus, and we know the importance of the 180-day payment deadline. The next question is, how should a tax preparer actually administer the process from start to finish? This slide presents a professional workflow for year-end bonus planning. The process begins by determining the bonus amount. This step involves reviewing the corporation's financial results, estimating taxable income, and deciding how much compensation should be paid to achieve the desired tax planning outcome. The goal is to balance corporate tax savings with the owner's overall compensation strategy. Once the amount has been determined, the next step is preparing a bonus resolution. This document formally records the corporation's decision to pay the bonus. It provides evidence of the corporation's intent and becomes an important part of the supporting documentation. After the resolution is prepared, the bonus payable is recorded in the accounting records. An accounting entry is made that increases salary expense and creates a bonus payable liability. At this point, the corporation has recognized the obligation to pay the bonus. The next step is processing the bonus through payroll. This is a critical stage because the bonus should generally be treated as employment income. Payroll calculations must be completed, and required deductions, such as income tax and CPP, must be determined. Once payroll processing is complete, the bonus can be paid. The employee or owner-manager must actually receive the payment, whether by direct deposit or check. Remember, payment is what turns a declared bonus into a completed compensation transaction. After payment has been made, source deductions must be remitted to the Canada Revenue Agency. These remittances must be made by the required deadlines. Missing remittance deadlines can lead to penalties, interest charges, and unnecessary CRA scrutiny. The final step is reporting the bonus on the T4 slip and maintaining payroll records. The bonus should be properly reflected in year-end payroll reporting, and all supporting documents should be retained as part of the corporation's permanent records. Now let's look at the professional best practices shown on the left side of the slide. Successful practitioners maintain written bonus resolutions. Keep complete payroll documentation. Track payments carefully. Monitor deadlines. And perform regular compliance reviews. These habits help prevent mistakes and provide strong support if CRA ever reviews the file. On the right side of the slide, we see some of the most common mistakes. These include declaring a bonus, but never paying it, missing the 180-day deadline, paying the bonus outside the payroll system, failing to withhold source deductions, maintaining poor documentation, and neglecting follow-up procedures. Notice that most bonus-related problems are not caused by complex tax rules. They are caused by weak administration, missed deadlines, and incomplete documentation. The key lesson from this workflow is simple. Successful bonus planning requires 3 things working together: proper documentation, proper payment, and proper timing. When all 3 are managed correctly, the result is a compliant, well-documented, and tax-efficient compensation strategy that achieves the intended planning objectives while minimizing CRA risk. This is the professional approach to year-end bonus administration, and it is the standard every tax preparer should strive to follow.